Most people walk past a pawn shop and assume they understand it. Old televisions in the window, a glass case full of jewelry, maybe a rack of electric guitars nobody's come back to claim. It looks chaotic, almost accidental, like a garage sale that decided to become a business. And that assumption, that this is somehow a simple or unsophisticated industry, is one of the most expensive misconceptions in retail economics. Because here's the thing. The pawn industry in the United States alone generates somewhere between $11 and $14 billion in annual revenue. There are roughly 11,000 pawn shops operating across the country right now. And the largest publicly traded pawnbroker in the world, First Cash Holdings, posted net revenues of over $2 billion in 2022. This is not a fringe business. This is not a relic. This is a fully functioning, surprisingly intricate economic machine, and almost nobody understands how it actually works. So today, we're going to pull back the curtain. Not just on the loans and the merchandise, but on the cost structure, the risk model, the regulations, the psychology, and the surprisingly delicate economics that determine whether a pawn shop survives or quietly disappears. Because running one is a lot harder than it looks. And the ones that do it well are doing something genuinely interesting. Let's start at the beginning. The pawn industry is one of the oldest financial systems in human history. You can trace the basic model back to ancient China, roughly 3,000 years ago. Medieval Europe had pawnbrokers operating under the church, which created all sorts of theological tension around the concept of charging interest. The Medici family, the famous Florentine banking dynasty, ran a sophisticated pawnbroking operation in the 15th century. The three golden balls that still hang above pawn shops today, that symbol comes directly from the Medici coat of arms. In America, pawn shops took hold rapidly in urban areas throughout the 19th century. They served the working class in an era when banks weren't interested in small, short-term loans to people without significant assets. And that's the foundational economic reality that explains why pawn shops exist at all. They serve a customer base that the formal banking system has largely ignored. Today, roughly 63 million Americans are either unbanked or underbanked, meaning they either have no bank account or lack access to traditional credit products. For these households, a pawn shop isn't a last resort, it's often the only resort. And that's not a small market. That's an enormous, underserved segment of the population that needs access to short-term liquidity. Pawn shops fill that gap, which is why, despite decades of fintech disruption and the rise of payday lending, the pawn industry hasn't collapsed. It's actually grown. Now here's where the business model gets genuinely interesting, because most people think a pawn shop is primarily a retail store. It isn't. At its core, a pawn shop is a collateral-based lender. The retail side, the stuff in the cases and on the shelves, that's almost a byproduct. Here's how the loan side actually works. A customer walks in with something of value: a piece of jewelry, a guitar, a gaming console, a power tool. The pawnbroker assesses the item, determines what they'd be willing to lend against it, and offers a loan. The customer gets cash. The shop holds the item as collateral. The customer then has a set period, typically 30 to 90 days depending on the state, to come back, repay the loan plus interest and fees, and reclaim their item. If they don't come back, the shop keeps the item and sells it. That's the entire loop. And it sounds simple. But the economics embedded in that loop are anything but. Let's talk about the interest rates, because this is where pawn shops get a lot of criticism, and where the numbers require some real context. A typical pawn loan charges somewhere between 10 and 25% per month in interest, depending on state regulations. Annualized. That sounds predatory. We're talking rates that could technically reach 200% or more per year. But here's why that comparison breaks down. Pawn loans are not annual loans. The average pawn loan lasts between 30 and 60 days. The borrower isn't paying 200%. They're paying on a $100 loan somewhere between $10 and $25 in total interest before reclaiming their item. And crucially, there's no credit check, no application, no risk to the borrower's credit score if they default. They simply walk away and lose the item. That's a fundamentally different risk profile than a traditional loan, and the pricing reflects that. Now comes the part nobody talks about when they evaluate the pawn business model: what happens to the item if the customer doesn't come back. On average, pawn shops see a redemption rate, meaning customers returning to retrieve their items, of somewhere between 70 and 85%. That number is actually higher than most people expect. The majority of people who pawn something do come back for it, which means the shop collects its interest and fees and returns the collateral. Clean transaction. Good margin. But that other 15 to 30%, those items become retail inventory. And this is where the pawn shop's second revenue stream kicks in. The shop paid effectively nothing for these items beyond the loan amount, and often the loan was structured conservatively enough that reselling the item at market value generates a healthy margin. A shop might loan $40 on a gaming console worth $120. If the customer forfeits, the shop sells it for $100. That's a $60 gain on a $40 investment. A gross margin of 60% or better numbers most retailers would find extraordinary. But, and this is a critical but, that math only works if the original valuation was accurate. And valuation is where pawnshop economics get genuinely difficult. Think about what a pawnbroker actually needs to be able to do. On any given day, they might need to assess the value of a diamond ring, a vintage Fender Stratocaster, a lawnmower, a designer handbag, a laptop, a set of golf clubs, and a piece of sports memorabilia. Each of those categories has its own resale market, its own price volatility, its own authentication challenges, and its own set of risks. Loan too much, and if the customer defaults, you can't recover your money. Loan too little, and you lose the customer to a competitor. This is why experienced pawnbrokers are, in a very real sense, professional appraisers across dozens of categories simultaneously. They subscribe to pricing databases. They check live eBay sold listings. They follow gold and silver spot prices daily, sometimes hourly, because precious metal prices move with the market. And a ring worth $300 on Monday might be worth $280 on Wednesday. They develop what amounts to pattern recognition through thousands of transactions, an instinct for what will sell, what won't, and how long it will sit. Getting this right is genuinely skilled work, and yet it's performed in a fast-paced retail environment, often in under 5 minutes per transaction. That combination of speed and precision is harder than it looks. Let's talk about the cost structure of actually running one of these businesses, because this is where a lot of aspiring pawnbrokers get a painful education. A pawn shop's single largest operating expense is usually its physical location. Pawn shops need to be accessible, high-foot traffic, easy parking, visible from the street. In a mid-sized American city, you're looking at commercial lease rates anywhere from $15 to $40 per square foot per year, depending on location. A shop of 2,000 to 3,000 square feet might carry a rent burden of $30,000 to $80,000 annually. That's before utilities, insurance, and maintenance. Insurance is particularly interesting for this business. A pawn shop holds thousands to hundreds of thousands of dollars in inventory jewelry, electronics, firearms in many cases. The liability exposure is significant. A comprehensive commercial policy covering inventory, general liability, and robbery can run anywhere from $8,000 to $25,000 per year for a mid-sized shop. And firearms? If the shop deals in them, which roughly 40% of pawn shops in the U.S. do require a federal firearms license, with its own compliance costs and inspections. Then there's staffing. A typical independent pawn shop employs somewhere between 3 and 8 people, depending on size and hours. The manager or owner is usually the most skilled appraiser in the building. Staff wages in the industry average somewhere around $15 to $20 per hour for experienced employees, plus benefits if the shop offers them. For a shop with 5 full-time employees, total labor costs including payroll taxes can easily reach $150,000 to $200,000 per year. And then there's the capital, the actual money sitting in the loan portfolio. This is something people rarely think about, but it's fundamental. To make loans, you need cash on hand. A pawn shop's outstanding loan balance is effectively dead capital money that's been deployed and is waiting to be repaid or converted into inventory. A healthy mid-sized shop might carry a loan portfolio of $100,000 to $300,000 at any given time. That capital has to come from somewhere. For independent operators, it's often personal savings, a business loan, or years of accumulated profit. Managing that capital efficiently is one of the most important skills in the business. Here's where it gets interesting on the competitive side. The pawn industry has undergone a significant structural shift over the last 30 years, driven almost entirely by the rise of national chains. Easy Corp, First Cash, and the legendary pawnbroker turned media phenomenon, Gold and Silver Pawn Shop from the show Pawn Stars. These names have fundamentally changed how the public perceives the industry. First Cash alone operates over 3,000 locations across the United States and Latin America. They have centralized buying teams, proprietary valuation software, bulk jewelry processing facilities, corporate relationships with secondary wholesale markets. Their cost structure per transaction is dramatically lower than an independent shop because they operate at scale. And yet, this is genuinely surprising. Independent pawn shops haven't been wiped out. In fact, independents still represent the majority of pawn locations in the US. The reason is interesting. Pawn shops are deeply hyperlocal businesses. A store's reputation in its specific neighborhood, its relationships with regular customers, its flexibility in valuation and negotiation, these things matter enormously and don't scale easily. A national chain has systems. An independent owner-operator has relationships. In this business, relationships translate directly into loan volume and customer retention. The regulatory environment is another layer that adds real complexity and cost to the operation. Pawn shops in the United States are regulated at the state level, meaning the rules around interest rates, loan terms, holding periods, and licensing vary dramatically from one state to the next. In Florida, for example, pawn shops can charge up to 25% per month on loans under $100, stepping down to different rate caps at higher loan amounts. In California, rates are capped lower, and the regulatory framework is more restrictive. In some states, the shop must hold a pawned item for a mandatory period, often 30 days before they can legally sell it, even if the loan has expired. This is partially designed to give customers a last chance to reclaim items, and partially designed to help law enforcement identify stolen goods. That last point brings up one of the most significant compliance obligations in the business. Pawn shops are legally required in most jurisdictions to record detailed information about every item they acquire, description, serial numbers where applicable, and the seller's identification, and submit those records to local law enforcement. Many shops are connected to real-time databases that automatically flag items matching police reports for stolen property. This system serves a genuine public purpose. Pawn shops have historically been a choke point for stolen goods, and the regulatory reporting requirements help address that. But compliance isn't free. The software, the staff time, the occasional interaction with law enforcement investigations, it's a real operational overhead that most people outside the industry never consider. Now let's get into the actual economics. What does a pawn shop realistically make? And what does it take to build one into something genuinely profitable? A well-run independent pawn shop in a decent market might generate total revenues combining loan interest, fees, and retail merchandise sales somewhere between $500,000 and $1.5 million per year. The range is wide because location, market size, and operator skill vary enormously. Out of that revenue, after rent, labor, insurance, inventory losses, shrinkage, and miscellaneous operating costs, a successful shop might generate a net operating income somewhere in the range of 15 to 25%, call it $75,000 to $300,000 in profit, depending on scale. That's actually a respectable margin for a brick-and-mortar retail business. For comparison, traditional retail averages net margins of 2 to 5%. Grocery stores operate on margins of 1 to 3%. The pawn model, when executed well, is meaningfully more profitable than most physical retail, partly because the inventory was acquired at deep discounts, and partly because the lending side generates income that has very little in common with merchandise retail. But here's the problem. Getting to that profitable range is not guaranteed, and the failure rate for poorly managed pawn shops is significant. The single most common path to failure is bad valuation. A shop that consistently overloads on items that don't sell overpriced jewelry in a market that prefers electronics, or niche collectibles with limited local demand, will find itself cash poor and inventory heavy. Liquidity is everything in this business. If the cash is tied up in slow-moving merchandise, the shop can't make new loans. If it can't make new loans, it doesn't generate interest income. The whole model stalls. The digital age has introduced another dynamic that didn't exist a generation ago, and it's reshaping the industry in ways that cut in multiple directions simultaneously. On one hand, platforms like eBay, Facebook Marketplace, and Craigslist have given pawn shop owners new outlets to sell merchandise. Items that would have sat in a case for months can now be listed online and sold to buyers across the country. This is genuinely valuable. It increases inventory turnover, which improves cash flow, which allows more loans to be made. On the other hand, those same platforms have made customers dramatically more informed. When someone walks into a pawn shop with a vintage watch, they've already looked it up on eBay. They know what it's sold for in the last 30 days. This has compressed margins on popular, easily searchable items because both sides of the transaction now have access to the same market data. The information asymmetry that historically benefited pawnbrokers has narrowed significantly. What this means in practice is that pawn shops can no longer rely on a customer's ignorance to generate margin. The shops that thrive today are the ones that compete on speed, convenience, trust, and the breadth of categories they can handle, not information advantage. It's a different competitive game than it was even 15 years ago. And then there's the question of what the future actually looks like for this industry, because there are forces pulling it in genuinely contradictory directions. On the growth side, economic instability is almost directly correlated with pawn shop activity. During the 2008 financial crisis, pawn volumes surged. During the early months of COVID-19 economic disruption in 2020, many shops saw loan volume increase significantly as households needed short-term liquidity. A pawn shop is, in economic terms, a counter-cyclical business. It tends to do better when the broader economy does worse. That's an unusual characteristic, and for investors and operators, it provides a certain kind of resilience that most retail businesses simply don't have. On the challenge side, buy now, pay later platforms, digital lending apps, and the slow expansion of financial products targeting underserved communities are all trying to serve the same customer base that pawn shops have historically dominated. Apps like Earnin, Dave, and various community development financial institutions are offering small dollar, short-term credit products with lower effective interest rates and no collateral requirement. Whether these products ultimately replace pawn lending or simply serve a slightly different segment remains an open question. But the competitive pressure is real, and it's growing. What seems clear is that pawn shops serving customers who need physical asset-backed loans, people without credit history, without income documentation that works with digital underwriting, or who simply prefer a cash transaction with no digital footprint will continue to have a market. The floor isn't going anywhere. But the ceiling on growth faces more pressure than at any previous point in the industry's history. Here's what makes this industry genuinely fascinating when you step back and look at it whole. The pawn shop sits at an unusual intersection of banking, retail, valuation expertise, and community finance. It's simultaneously one of the oldest business models in human civilization, and one that requires continuous adaptation to survive in a modern market. The economics reward operators who are skilled in ways that almost no other retail business demands equal parts banker, appraiser, salesperson, inventory manager, and regulatory compliance officer. An owner who masters all of those disciplines simultaneously and builds genuine relationships in their community can run a business that generates real, sustainable income with margins that outperform almost any comparable physical retail category. But the entry barriers are real. The capital requirement, the expertise requirement, the regulatory complexity, and the reputational challenges that still attach to the industry despite decades of change. These are not trivial obstacles. The image problem alone has real economic consequences. A pawn shop that's perceived by its neighborhood as predatory or exploitative loses customers who might otherwise benefit from its services. The shops that have successfully repositioned, presenting themselves as community financial resources, transparent in their pricing, fair in their valuations, consistently outperform the ones still operating on the old model of information advantage and take it or leave it offers. And maybe that's the deepest lesson in the economics of pawn shops. The business model works when it actually serves both sides of the transaction. When it gives customers a fair price for their collateral and a realistic path to getting their items back, the redemption rate stays high, the reputation stays clean, and the loan volume grows. When it extracts maximum margin from desperate customers, it might generate short-term income, but it erodes the customer base over time. Sustainable pawn economics look a lot like sustainable economics anywhere else, built on repeat customers, honest transactions, and a genuine value proposition on both sides of the counter. The three golden balls hanging out front have meant a lot of different things over the centuries. Right now, in 2024, they mean something surprisingly modern, a business that works when it's run with discipline, expertise, and a real understanding of the community it serves.